In tonight's video, I want to go over a common mistake that many amateur, novice, or even intermediate traders make. Very often, and this isn't exclusive to gold or anything else, it's just uh, the way markets work. When you get a really strong rally or a really strong decline, I'm gonna use a rally for the sake of this video because I'm looking at the gold chart here. But the tendency is that when a price rallies very strongly, a novice or even an intermediate type trader, they tend to assume that a really strong rally means that any correction is going to be very mild. But that's not generally how markets work. I call it the rubber band theory. Basically, it's just the tendency for markets to regress to the mean. So a really strong rally that pushes price very far above or below the average. In this case, I'm using the 50-day moving average. That doesn't generally mean that the correction is going to be very mild and then off we go to the upside again. There are a couple of times, certain phases in a bull or bear market where that can be the case. During the baby bull, the market can get stretched far above the mean and then not correct very much, similar to what happened right here. You can see the market took off and it just kept going and going, and then when it corrected, it wasn't a very deep correction before the next leg up again. That's one time. Also during a bubble phase, the market can just ignore the forces of regression to the mean for quite a while. But gold is not in either one of those phases. The baby bull is over. We're years away from the bubble phase yet. We're just now starting the adolescent phase of the bull market. So the forces of regression should work, perfectly well in the gold market during, the next several years. So this kind of goes along with what I've been saying for the last week or so, that it's getting late. This rally has lasted almost 2 months. We're I think 41 days into this daily cycle. It's already a very stretched daily cycle, and at some point we're going to have a correction down into a daily cycle low. So I would not assume that the correction is going to be really mild. The reason being is price has gotten stretched a long ways above this 50-day moving average. So there's a very real possibility that when we do start to correct, the correction is going to be quite severe, and gold could even go back down to test this 50-day moving average. It's not out of the question. Let me shrink the chart here just a little bit. One of the things that I suggest traders do is to put a Fibonacci retracement, the Fibonacci retracement levels onto a chart. When you're due for a move down into a daily cycle low, you can get some idea of what to expect. So in gold, I'm going to tell you that 38% is in the bag. That one is a given. A move down into a daily cycle low is going to retrace at least that much. So you've got to at least plan on that. Now, I'm not saying that the top occurred today. It may have, but if it didn't, if we've still got further to go, then you just adjust this Fibonacci chart. But you've got to plan on the daily cycle low at least going to the 38% retracement. And very often it'll go to the 50% retracement, and you can see where that would be. It's going to be right here at this 50-day moving average. So for those of you that just keep pressing leverage further and further. You've got to accept that if you're going to keep pressing the leverage, then you are going to get caught in the daily cycle low. And if gold retraces 50%, then you better, if you're in a 3 times fund, then you've got to multiply that times 3. So now let's convert over to the GDX chart and let's get some idea of where a possible retracement could make it back to in GDX. And then you can multiply that times 3, and you can get some idea of what you're going to have to hold on through if you plan on holding a 3 times leveraged fund. Okay, so let's just assume the worst case scenario. We retrace back to the 50%, which is at about just a little over $23 from its current price. That's just assuming that this was a top today. I'm not suggesting that I know that this is a top today, but if it were, then I think you have to, worst case scenario, you got to plan on a trip back to the $23 level. And if you're in a leveraged fund, that's about a little over 8%. So in a leveraged fund, you're looking at a 26% drawdown. If you think that you're going to be able to hang on through just what would just be a very normal correction into a daily cycle low. So this is why I keep stressing here that this is a much better time to be off leverage. We're 41 days into this daily cycle. At some point here, we are going to get a move down into a daily cycle low. When we do, it's at least going back to the 38% retracement. And I think you should plan on a 50% retracement. And if you think you're going to hold a leveraged ETF through a 50% retracement, you better understand that that's a 26% drawdown from the top. So ask yourself if you can realistically hang on during that kind of a corrective move. And if the answer is no, then you need to get off your leverage and just get back to an unleveraged fund so that the drawdown is more manageable. It would only be 8% in GDX, and then once you get down here, then you could convert back to the leveraged fund for the ride back up, and I believe we're going to not only go back above this level, assuming this was a top, but not only go back above this level, but I think we're going to test the 2016 highs, which I believe are right around $30, something like that. So it would just be much easier to ride the correction out unleveraged, put your leverage back on as close to the bottom as you could pick, and then you can ride that leverage back up for the next leg up in this bull market. And trust me, you're going to sleep a lot better, and the chances of getting an ulcer will be greatly diminished if you have to weather a cycle low. Do it in unleveraged funds.